The soft landing is a fairy tale. We're losing full-time jobs and replacing them with part-time desperation, while the Fed drives looking only at the rear-view mirror.
Former Fed advisor Danielle DiMartino Booth says the engine is stalling, and she's not alone. We've used AI to distill hours of deep dive analysis from experts like Jeff Snider and Marc Faber into just minutes of actionable intel.
Get ready to see exactly where the bodies are buried in the job market, and why a specific currency level in Asia could trigger a global meltdown.
First, Danielle reveals why the job market headline numbers are a total bait and switch. Just a reminder, this is for education, not financial advice.
We're breaking down a heavy-hitting discussion between the Schwab Network host and Danielle DiMartino Booth, a former Fed advisor who thinks the soft landing narrative is a fairy tale.
Danielle has spent years inside the Fed, so when she says they're misreading the room, people listen. Her big takeaway? The economy is much more fragile than the headlines suggest.
Wait, former Fed advisor? So she knows exactly how they cook the books?
Let's just say she knows where the bodies are buried. She's looking at data points the Fed seems to be ignoring.
Danielle's analysis highlights that the massive interest rate hikes we've seen have a lag, and that lag is finally catching up to everyday spenders.
So the pain hasn't even fully arrived yet. I thought we were almost through this.
According to Danielle, we're just getting to the finding out stage of the cycle.
Exactly. While the market is celebrating, Danielle's looking at credit cards and job quality, and the view isn't pretty.
Danielle points out a massive red flag. We're losing full-time jobs and replacing them with part-time ones.
It's a classic bait and switch. The headline number looks fine, but the quality of employment is cratering.
Wait, so the strong job market everyone is talking about is just people taking second jobs to survive?
That's exactly Danielle's point. It's not growth, it's desperation.
It's like saying you have more food because you cut your one steak into 20 tiny pieces.
And I'm still hungry. Got it.
Danielle's data shows that credit card delinquencies are spiking, especially among lower-income borrowers.
We're talking levels we haven't seen in a decade. People have exhausted their pandemic savings and are now hitting the limit on their plastic.
Is that why my bank keeps sending me urgent emails about my balance?
Probably. When the cost of everything goes up and your full-time job disappears, the credit card is the only thing left.
And with rates at 20+%, that debt is a ticking bomb.
So we're basically charging our way into a recession.
Danielle also highlighted the pain for small businesses. They don't have the cash reserves of a tech giant.
Right. They're the ones feeling the full force of the Fed's 5.5% rate.
Wait, so if small businesses can't borrow, they can't hire, right?
Exactly. They're already cutting back, which feeds right back into that job loss cycle Danielle mentioned.
It's the engine of the economy stalling out while the Fed watches the dashboard of the high-end luxury cars.
That's a terrifying metaphor, but I get it.
One of Danielle's sharpest critiques is that the Fed is driving the car while looking only in the rearview mirror.
They rely on lagging indicators like CPI and old unemployment stats, but the real-time data Danielle sees is already turning red.
Hold on. Why would they look at old news to make future decisions?
Because it's safe and verifiable, but as Danielle points out, it makes them way too late to react to a crash.
By the time the Fed's data shows a recession, we'll already be 6 months into it.
Great, so the pilot realizes we're crashing after we hit the ground.
Danielle predicts a reality check for the job market as soon as these seasonal adjustments stop masking the layoffs.
She's looking at a significant spike in the unemployment rate, possibly crossing the 4% threshold quickly.
4%? Is that really that bad?
In the world of the Fed, that's the SOM rule territory, the point of no return for a recession.
Once it starts moving, it doesn't just stop. It's a snowball effect.
So basically, the winter is coming for the job market.
Danielle believes the Fed will have to pivot and slash rates, not because inflation is gone, but because the economy is breaking.
If her analysis is right, those cuts won't be a sign of success. They'll be an emergency rescue mission.
So rate cuts could actually be a bad sign? I thought that made stocks go up.
Only if it's a soft cut. If it's a panic cut, the market might realize just how deep the hole is.
Danielle's warning is clear. The Fed usually breaks something before they fix it.
Note to self, brace for impact.
Danielle's top advice? Ignore the headline job numbers and look at the ratio of full-time to part-time work.
If full-time jobs keep disappearing, that's your signal that the recession has arrived, regardless of what the Fed says.
So I should check the BLS reports myself.
Just keep an eye on the household survey part of the report. That's where Danielle says the truth is hiding.
Another actionable tip from Danielle, watch the delinquency rates at major banks.
When the consumer breaks, the rest of the economy follows suit pretty quickly.
So if people can't pay their cards, the soft landing is officially dead.
Exactly. Danielle's work at QI Research suggests that's exactly where we're heading.
Got it. Pay attention to the plastic.
All right, everyone, the numbers are out. Matt deWolf is breaking down the latest CPI report, and the headline number hit right at 0.2% for the month.
Exactly what the market expected, but Matt warns that the devil is in the details, especially with core inflation looking a bit stickier.
Wait, 0.2%? That sounds tiny. Why are the charts going crazy if it was expected?
Because in the market, expected is just a guess, and the reaction tells the real story. Plus, we have a massive surprise in the S&P 500 that we're revealing in just a second. Matt deWolf points out that while the headline was fine, core CPI actually ticked up to 0.3%.
That is the real kicker. It is higher than the 0.2% estimate, meaning services and housing costs aren't cooling as fast as the Fed wants.
Hold on. So if core is higher, does that mean the stuff we actually need, like rent and insurance, is still getting pricier?
Precisely. Matt notes that this makes a jumbo 50 basis point rate cut much less likely now.
It is like a cold shower for the bulls who wanted a massive pivot.
So much for that cheap money, I guess.
Let's look at the price action. Matt deWolf saw the S&P 500 futures plunge to 5,450 immediately after the print.
It was a wild flush, but it held that support level before snapping back. It shows the market is still fighting to stay bullish.
Wait, it dropped and then went back up? So it was just a fake out?
Matt calls it clearing the stops. They shake out the weak hands before the real move starts.
And with 5,500 acting as a massive psychological ceiling, the tug-of-war is intense.
Sounds like a great way to lose money if you aren't paying attention.
The tech-heavy Nasdaq saw even more drama. Matt highlighted that the QQQ fell sharply as yields reacted to that sticky core number.
Higher yields are like kryptonite for tech stocks because it makes their future earnings look less attractive.
Yields? You mean interest rates on government bonds?
Exactly. When the 10-year yield jumps, tech investors start sweating.
Matt saw a quick rotation out of high-growth names as the reality of higher for longer set back in.
So my tech stocks are basically on a roller coaster right now.
Even gold got in on the action, hovering around $2,500 an ounce during Matt's analysis.
Gold is the ultimate fear gauge here. If people don't trust the dollar or the Fed, they run to the yellow metal.
2,500. I remember when it was way lower. Is it too late to buy?
Matt suggests watching the dollar. If the dollar stays strong because of these rates, gold might struggle to break higher.
It is a massive battle at that 2,500 level, a real line in the sand.
I think I'll just stick to my piggy bank for now.
After this data, Matt deWolf sees the probability of a small 25 basis point cut soaring to 85%.
The dream of a 50 basis point jumbo cut is basically dead. The Fed doesn't want to look like they're panicking while inflation is still 0.3%.
So they're just going to do a tiny cut. Will that even help with my credit card interest?
Probably not much. It is more about the signal it sends to the market than the actual math for your wallet.
It is a baby step approach, and Matt thinks it could lead to more choppy trading.
Great, more choppy water, just what my stomach needs.
Matt's technical analysis suggests that if we can hold 5,450, the next target is 5,600.
But that is a big if. If we break below 5,400, the floor could fall out toward 5,300.
So we're either going to the moon or the basement. Can't we just stay in the kitchen?
In this market, no way. The volatility is the point. Matt notes we're in a high-stakes range right now.
Expect lots of fake breakouts and quick reversals.
Note to self, don't look at my 401k today.
The takeaway from Matt deWolf, watch 5,500 like a hawk.
If we can close above it and stay there, the bulls have control. If not, expect a retest of the lows.
So 5,500 is the magic number. Got it.
Exactly. And keep an eye on the dollar index too. Its strength will dictate where stocks go next.
Stay disciplined, because the next few days leading to the Fed meeting are going to be wild.
Wild? I'll bring the popcorn.
The U.S. housing market has officially broken in two, and Nick Gerli from Reventure Consulting is sounding the alarm on this massive geographical split.
It is wild. Nick points out that while the Sunbelt is drowning in new listings, the Midwest and Northeast are still stuck in a massive inventory desert.
Wait, so it is not just one big national market anymore? My brother in Florida is seeing houses sit forever, but my friend in Boston is still in bidding wars.
Exactly. Nick's data shows that depending on your zip code, you are either in a buyer's paradise or a seller's fortress. And while we dig into the southern crash, wait until you see why the North is refusing to budge. Nick Gerli is highlighting a massive shift in the Sunbelt, with active listings in Florida and Texas surging over 50% year over year.
That is a huge supply shock. Builders overextended themselves, and now those markets are hitting months of supply levels we haven't seen since the last crash.
50%. So there are literally 50% more for sale signs in Florida than there were last year.
Precisely. When inventory grows that fast, sellers lose their leverage instantly.
It is a total vibe shift from the bidding wars of 2021.
So if I am looking for a deal, I should be looking south.
Now, the other half of Nick Gerli's broken market is the North, where inventory is still 40% below pre-pandemic levels.
It is a supply desert. People in the Midwest are locked into 3% mortgage rates, and they are simply refusing to move.
40% below normal. No wonder my cousin in Ohio can't find a single decent starter home.
Nick explains this as the lock-in effect on steroids. If you sell, you swap a cheap loan for a 7% one. Who wants to do that?
Nobody. So the market just freezes up, keeping prices artificially high despite high interest rates.
So the North is basically a game of real estate musical chairs where no one wants to stand up.
Why aren't builders just fixing this by building more in the North?
Nick points out that almost 90% of new home construction is happening in the South. Builders go where the land is cheap and regulations are light. And
wait, 90%? So the North is getting zero help from new builds.
Essentially, the new supply is flooding markets that already have rising inventory, while the thirsty markets stay dry.
It is a massive misallocation of resources. We are overbuilding in Austin and underbuilding in Chicago.
That sounds like a recipe for a localized crash in one place and a forever shortage in the other.
Nick highlights Austin as the poster child for this shift, where months of supply has hit 4.5.
For context, anything over 4 months starts tilting toward a buyer's market. Sellers are actually starting to offer concessions again.
Concessions? Like, they'll pay for my closing costs or fix the roof without a fight.
Exactly. They are even buying down interest rates for buyers just to get the deal done.
Nick's data suggests this is just the beginning for these oversupplied Sunbelt hubs.
Finally, the tables are turning somewhere.
So what is the endgame? Nick Gerli predicts Sunbelt prices could drop 10 to 15% as that inventory keeps piling up.
It is simple math. If demand doesn't return at 7% interest rates, prices have to be the pressure release valve.
10 to 15% off. That is a huge chunk of equity just vanishing for people who bought at the peak.
It is. Nick warns that late-cycle buyers in places like Phoenix and Tampa might find themselves underwater soon.
But for those waiting on the sidelines, it's the opportunity they've been praying for.
So it's bad news for sellers, but a clearance sale for me.
And the North? Does it ever get cheaper?
Nick thinks northern markets will stay in a frozen state with very low volume until mortgage rates drop closer to 5.5%.
So if rates stay high, the North just stops moving, like a parked car?
Pretty much. Prices won't crash because there is no supply to force them down, but nobody is buying either because it's too expensive.
It is a stalemate. Nick calls it a zombie market. It is not dead, but it's not really alive.
I'll take the clearance sale in the South over the zombie market in the North any day.
Nick Gerli's main takeaway is to stop looking at national averages and start tracking months of supply in your specific city.
Right? If your local supply is under 3 months, don't expect a discount. If it is over 5, start lowballing.
So I need to become a data nerd for my own neighborhood. Where do I even find that?
Nick recommends using tools like the Reventure app to see the raw inventory numbers before the headlines catch up. Nick also suggests prioritizing cash flow over price appreciation right now.
In a market this split, you can't bet on prices going up everywhere anymore. The dumb money phase of real estate is over.
Wait, so I should actually make sure the rent covers the mortgage? What a concept.
Exactly. According to Nick, that is the only way to survive the great housing divide.
Focus on the numbers, not the hype. The data doesn't lie, even if the market is broken.
Got it. Checking inventory, ignoring the noise. Let's see what's happening in my zip code.
The yen just hit a 34-year low near 160, and Jeff Snider says this isn't a Japan problem. It's a global dollar warning shot.
Exactly. Jeff's analysis shows that when the yen collapses like this, it's proof that the Eurodollar system, the plumbing of global trade, is running bone dry.
Wait, 160. Last I checked, it was way lower. Is that why my sushi is getting cheaper, or is the world actually ending?
The cheap sushi is the only upside. The downside is that Jeff believes this signals a massive shortage of dollars that will eventually hit every market, including ours.
So the yen is the canary in the coal mine, and the canary just stopped singing. But wait until we talk about what China is doing with the yuan. That's where it gets really scary. Jeff Snider's core thesis is that the 14% drop in the yen this year isn't about interest rates. It's about a lack of collateral in the banking system.
Right. Everyone blames the Bank of Japan, but Jeff points out that even their interventions can't stop the bleeding because they can't create real Eurodollars.
Hold on, Eurodollars. Are we in Europe or Japan? I'm already lost.
Eurodollars are just US dollars held outside the US. Jeff explains they are the lifeblood of global trade. When they disappear, currencies like the yen tank.
So basically, the world is playing a game of musical chairs with dollars, and the music just stopped for Asia.
And let me guess, Japan doesn't have a chair?
Japan tried to intervene, but the yen kept sliding. Jeff Snider argues this proves the market is bigger than any central bank.
They're basically trying to put out a forest fire with a water pistol. Jeff notes that the fundamental demand for dollars is simply too high.
Wait, If they have billions in reserves, why can't they just buy their own currency back?
Because as Jeff explains, those reserves are often tied up in US treasuries. Selling them just creates more chaos in the bond market.
It's a damned if you do, damned if you don't scenario. Jeff calls it a disorderly breakdown.
Disorderly sounds like code for everyone panic, doesn't it?
Jeff also highlights the yuan. China is fighting tooth and nail to keep it from breaking, but the pressure is building.
Jeff's data shows the People's Bank of China is using hidden interventions to keep the yuan stable, but it's clearly leaking.
If China's currency drops, doesn't that make their exports cheaper? Isn't that a win for them?
Initially, maybe. But Jeff warns it triggers capital flight. People start pulling their money out of China as fast as possible.
And when that happens, the dollar shortage gets even worse. It's a vicious cycle Jeff has been tracking for years.
So the Great Wall is actually a dam, and it's starting to crack.
Even the Bank of Indonesia hiked rates to 6.25% unexpectedly. Jeff says this is a total defensive move.
They didn't want to hike, but they had to. Jeff points out that emerging markets are now being forced to wreck their own economies just to protect their currencies.
6.25%. My savings account barely gives me 0.5. Maybe I should move my money to Jakarta.
Not unless you want to see your purchasing power evaporate. Jeff's point is that these countries are desperate for dollars, not their own cash.
It's the ultimate signal of a global squeeze. Jeff is adamant. This isn't about inflation anymore. It's about survival.
Okay, that's officially terrifying. What's next?
Jeff Snider is predicting that this currency collapse leads straight to a global deflationary shock.
Right, when currencies crash, trade slows down, and that eventually forces prices lower everywhere as demand falls off a cliff.
Wait, lower prices? I thought inflation was the big monster we were all fighting.
Jeff argues that inflation was a temporary supply chain issue, but this dollar shortage is a permanent structural problem that ends in recession.
So we're trading high prices for no jobs? That's Jeff's warning.
I think I prefer the expensive lattes over the no-job scenario.
Jeff expects we'll see more emergency meetings and surprise rate hikes through the end of the year.
He notes that the Fed might even be forced to open new swap lines if the offshore dollar market completely seizes up.
These swap lines. Is that like a payday loan for countries?
Kinda, it's the Fed pumping dollars to foreign banks. Jeff says if we see those open up, you'll know the situation is critical.
Basically, look for the break glass in case of emergency signs at the Fed.
Got it. Checking for glass shards as we speak.
Jeff Snider suggests keeping your eyes glued to that 160 level on the yen.
If it breaks and stays above that, Jeff believes it signals the next leg down for global equities and commodities.
So if the yen goes up, my stocks go down? Is that the rule of thumb here?
In this environment, yes. It's all about liquidity. No dollars means no buyers for anything else.
Finally, Jeff says to watch the TGA, the Treasury's bank account.
When the Treasury refills that account, it sucks dollars out of the system, making Jeff's shortage even more painful.
So even the government is hoarding dollars now. Great. Just great.
It's a tough outlook, but Jeff Snider's analysis gives us the roadmap. Watch the yen, watch the yuan, and stay liquid.
Stay liquid, I can do that. Does coffee count?
Only if you pay for it in dollars.
Adam Taggart just brought together two titans for a massive debate. Marc Faber, the legendary contrarian, and Brent Johnson, the architect of the dollar milkshake theory.
It was a clash of titans. Marc is looking at the end of Western hegemony, while Brent argues that the US dollar is the only game in town during a crisis.
Wait, Western what? Hegemony? Can we speak English for a second?
Basically, Marc thinks the US is losing its top dog status, and Adam Taggart is trying to figure out if that means our portfolios are about to get wrecked.
The big takeaway? Brent expects a massive squeeze into the US dollar, but Marc warns that war could send oil prices to $150 or higher.
So we have a dollar surge and an energy crisis hitting at the same time.
Hold on, $150 for oil? My gas bill is already killing me. Is that even possible?
According to Marc Faber, in a wartime scenario, supply chains don't just bend, they break. But while that sounds dire, Brent has a completely different view on where the money will hide, which we'll get into next.
Brent Johnson's core argument is the milkshake theory, that the US dollar is sucking up all the global liquidity like a giant straw.
Exactly. He believes that even if the US has problems, the rest of the world has it worse, forcing everyone to buy dollars to pay off debts.
Wait, so even if we're doing bad, we win because everyone else is doing worse?
That's exactly what Brent is saying. It's the cleanest dirty shirt in the laundry basket. Marc Faber isn't buying the dollar hype. He thinks the Iran conflict is the beginning of the end for US financial dominance.
Marc is leaning heavily into gold and emerging markets, especially in Asia. He sees the US dollar as a paper tiger.
So Brent says buy dollars and Marc says buy gold. Those are basically opposites.
Exactly. It's a fundamental disagreement on what counts as a safe haven when the world is on fire.
Marc Faber highlighted a huge risk, the Strait of Hormuz. If that gets blocked, oil supply disappears overnight.
He mentioned that 20% of the world's oil flows through that point. A shutdown could easily push prices past $150.
Wait, 20%? If that stops, do we just run out of gas?
Not run out, but you'll be paying double at the pump. It's an inflationary nightmare Marc is very worried about.
Brent Johnson has a counterintuitive take here. He says higher oil prices actually make the dollar stronger.
Hold on. How does expensive oil make our money worth more? That sounds backwards.
Because oil is priced in dollars. If oil goes up, countries need more dollars to buy it. It creates a massive demand spike for the greenback.
So Brent thinks the very thing that hurts consumers actually strengthens the currency's grip on the world. Marc Faber pointed out that the BRICS nations, Brazil, Russia, India, China, and South Africa, are moving away from the U.S. system.
He believes the Iran war will push these countries to settle trade in their own currencies or gold, bypassing the dollar entirely.
Is that like a rival club for the US? Can they actually pull that off?
Marc thinks they can. He argues that the weaponization of the dollar has made the rest of the world look for an exit strategy.
Brent Johnson is calling for the dollar index to surge past 110 as chaos erupts.
He expects a liquidity vacuum where everyone sells everything just to get their hands on US cash.
110. Is that like a record high or something?
It's very high. Last time we saw levels like that, global markets started breaking under the pressure. On the flip side, Marc Faber is warning of a potential 30% correction in US and European stocks.
He thinks investors will panic and dump paper assets for physical gold and real estate in neutral countries.
A 30% drop? My 401k would be in a coma. Is he serious?
He's Dr. Doom for a reason. He believes the valuation of US stocks is completely disconnected from the reality of global war.
To follow Brent Johnson's advice, you need to watch the DXY. If it starts climbing fast, the milkshake is in play.
If the dollar gets too strong, it's a sign that global liquidity is drying up. That's usually bad for stocks.
So if the dollar goes up, my stocks go down? Got it. Watching the ticker now.
Exactly. It's the warning siren for the rest of the market.
Marc Faber's takeaway is simple. Own gold. He sees it as the only true insurance policy against a failing currency system.
He recommends keeping a significant portion of your net worth in physical assets that aren't tied to any government.
So I need a safe and some gold bars? Seems a bit old school, but okay.
In a war, old school is usually what survives. Marc's data suggests that gold outperforms almost everything when empires shift.
The alpha for today is simple. Chris Vermeulen is warning that the stock market is hitting a massive technical ceiling right around 5,200 on the S&P 500.
Exactly. Chris's analysis shows that we are seeing a classic exhaustion pattern, and while the momentum is there, the smart money is already looking for the exit.
Wait, exhaustion? You mean the stock market is literally getting tired of going up?
Pretty much. Think of it like a marathon runner hitting a wall after 20 miles. The legs are moving, but there's nothing left in the tank.
And Chris points out that when the runner stops, the drop can be fast, potentially a 5 to 10% pullback.
5 to 10%? That's not a stumble, that's a faceplant.
Chris Vermeulen's core thesis is that technical indicators are flashing red, specifically with the S&P 500's price action.
He's watching the 20-day moving average. If we close below that, the trend officially breaks.
Hold on. What's a moving average? Is that like the average price over the last month?
Exactly. It smooths out the noise. When the price falls through it, it usually means the big institutional sellers have taken over.
And according to Chris, we are hovering right on the edge of that breakdown right now.
So we're basically standing on a banana peel.
Chris highlights a huge red flag, the divergence between big tech and small caps. Why is that a problem?
Well, in a healthy market, everything rises together. Chris points out that while the QQQ is at highs, small cap stocks are lagging behind.
So the cool kids are at the party, but nobody else showed up.
Exactly. When only a few stocks carry the whole market, the foundation is weak.
Chris calls this a thin market. If the tech giants stumble, there's no safety net below.
That sounds like a disaster waiting to happen for my 401k.
Chris Vermeulen uses cycle analysis to predict when these moves happen, and his data suggests a peak in the next 5 to 7 days.
It's about timing. Chris isn't saying the world is ending, just that the current rally is mathematically reaching its limit.
Wait, math can predict the stock market. Why didn't anyone tell me this in high school?
It's not perfect, but cycles repeat because human psychology repeats. Fear and greed are constants.
So within a week, Chris expects the momentum to flip from buy everything to save yourself.
I should probably put my phone away next week then.
Another thing Chris mentions is the VIX, the fear gauge. It's incredibly low right now.
Low VIX means traders are complacent. Chris warns that when everyone is this relaxed, the surprises are usually to the downside.
So it's like a horror movie, where it gets really quiet, right before the monster jumps out.
Spot on. Chris sees this low volatility as the calm before a potential storm.
History shows that when the VIX hits these levels, a spike is usually around the corner.
Great. I'll go buy some popcorn and a helmet.
If that 20-day moving average fails, Chris predicts a quick drop of 5 to 10%.
He believes the market needs to wash out the latecomers before it can ever try to go higher.
So a crash is actually good?
Chris calls it a healthy correction. It resets the prices and creates better entry points.
But for those holding at the top, it's going to feel like a lot of pain.
I'll stick to the less pain option. Thanks.
As stocks struggle, Chris sees a massive rotation into gold and silver miners.
He notes that precious metals often act as the anti-stock when the S&P 500 starts to wobble.
Gold? Like pirate treasure gold?
Basically, it's the ultimate safe haven. Chris's charts show gold miners are actually starting to look very bullish.
It's the classic pivot. When the paper market shakes, people want the hard stuff.
Maybe I should trade my stocks for a gold doubloon.
To wrap up Chris Vermeulen's outlook, your first job is to watch the daily close of the S&P 500.
If it closes below that 20-day average, Chris suggests tightening your stops or taking some profits.
So if the number is lower than the average, I should hit the sell button.
It's a signal to be defensive. Don't let a small loss turn into a big one.
Chris's philosophy is protect your capital first, make money second.
Got it. Safety first, then the yacht.
Finally, Chris suggests looking at your portfolio. Are you too heavy in tech?
With the tech divergence he mentioned, it might be time to look at those gold miners he's bullish on.
So less iPhone stocks, more shiny rock stocks.
That's the gist of it. Diversification is how you survive the exhaustion phase Chris is describing.
Keep a close eye on the volume next week. If it spikes on a down day, the correction has begun.
Well, I'm officially nervous and prepared. Thanks, Chris.
Let's recap what each guest brought to the table. First up, Danielle DiMartino Booth.
Her main argument is the reported job numbers are deceiving. They mask the underlying weaknesses in the job market.
So she's saying it's not just about numbers. There's more going on?
Exactly. She emphasizes that the facade of a strong labor market could easily crumble.
Now turning to Jeff Snider, his core thesis revolves around a looming dollar shortage.
That's right. He argues that as demand for dollars increases, the supply becomes more restricted, which could trigger widespread economic fallout.
So the stronger dollar could actually break things rather than fix them.
Exactly. It's a counterintuitive scenario.
Next is Marc Faber, who adds another layer. He links geopolitical instability with market vulnerabilities.
Faber warns that the dollar's strength may invite political upheaval from nations resentful of U.S. power, potentially disrupting markets.
So he's basically saying the world stage could affect my wallet?
Absolutely. Geopolitical events can have direct financial repercussions here.
And finally, Nick Gerli discusses the Sunbelt supply issues.
Right. He sees these regional supply shocks as indicative of shifts that could affect the national economy.
So it's not just local, this could spread? Wow.
Yes, it's all intertwined.
Lastly, Matt deWolf highlights core inflation's stickiness and how consumer expectations play a role.
Exactly. He believes those inflation expectations are becoming entrenched, delaying any significant economic recovery.
So I might need to budget more for groceries for a while? Ugh.
Unfortunately, yes, that's the reality.
Interesting consensus. All our guests highlight that current economic indicators, especially job numbers, are misleading.
Correct. Danielle's warning about the labor market aligns with Jeff's and Marc's concerns about broader economic stability.
So everyone thinks the facade is cracking. What does that mean for us?
It means we should all keep an eye on job quality, not just quantity. Danielle and Matt come together on the importance of consumer expectations driving inflation.
Yes, they agree that if consumers expect prices to rise, that expectation itself can keep inflation on a higher trajectory.
So if I'm worried about cash flow, that makes it worse.
Exactly. It's cyclical, and their insights show how interconnected everything is.
Turning to geopolitics, both Jeff and Marc highlight how external tensions can affect economic health.
Right? Their arguments suggest that unstable global relations could amplify financial crises here.
So the world's political drama could send my stocks tumbling?
Sadly, yes. We're more connected than we think. Let's talk differences. Danielle sees significant weaknesses in the labor market, while Jeff is fixated on dollar shortages.
Yes, Danielle argues that the job numbers are a mask for deeper issues, while Jeff believes those could be overshadowed entirely by dollar dynamics.
So one's saying the jobs are drying up, and the other thinks it's the currency that's key.
Exactly. They differ on prioritizing which issue could explode first. Marc is focused on global geopolitical influences. Nick, however, stresses the importance of local supply issues.
Right. Marc views the geopolitical landscape as the primary driver of market stability versus Nick's local perspective on supply constraints.
So, there's a tug of war between global and local issues.
Exactly. Both perspectives are valid, but highlight different priorities. On inflation, Danielle is optimistic about a downturn, while Matt feels it's embedded and sticking around.
Right. Danielle believes that the market will adjust potentially soon, while Matt warns that expectations have already solidified.
So one thinks we're close to correction, and the other sees more struggle ahead.
Exactly. That's an important contrast. If you found this insightful, smash that like button and hit subscribe.
We sift through in-depth analysis, so you don't have to.
Seriously, I feel like a genius after this. I'm totally subscribing.
Stay tuned for our next video. Thanks for watching.